Hello crypto enthusiasts and welcome to FinShark Updates, where the latest finance and crypto news and updates are brought to you. Recent economic downturns have proved that we may already be in a recession even before economists can announce one. A drop in the stock market might be an early warning sign of a recession. But according to Dimensional, don't sell your stocks just yet. Data reveal that 5 years after the S&P 500 entered a bear market, defined as a 20% drop from its recent peak, it averaged a 70% return. And in this video, we'll reveal everything you should know. What is a recession? It's often defined as a period when economic output contracts for 2 straight quarters. The National Bureau of Economic Research's Business Cycle Dating Committee, a group of academics whose determination is regarded as official in the US, defines it as a significant decline in economic activity that is spread across the economy and that lasts more than a few months, and looks at 3 criteria: depth, diffusion, and duration. To assess these criteria, they consider factors such as employment, inflation-adjusted spending, industrial production, and income. And while each requirement must be met to some degree, Enber says extreme conditions revealed by one measure may offset weaker signals from another. For instance, the pandemic-driven recession of 2020 was broad-based and characterized by a sharp drop in economic activity. But it was extremely short, lasting just 2 months. The recession is here. Bloomberg Economics says that they are close to a 3 in 4 recession probability by the start of 2024. Economists at Deutsche Bank AG, one of the first central banks to forecast a recession, now expect one to begin in mid-2023. Wells Fargo & Co. predicts the same. Nomura Holdings Inc. expects one even sooner, starting at the end of 2022. The likelihood of a recession could climb even higher if gasoline prices continue to rise and the Fed opts for another 75 basis point rate hike in July. When the central bank raised interest rates by that much in June, it was the most significant move since 1994. Indeed, the current signs suggest that the industry isn't in for a long landing in the coming months and years, since most of the Western world tactically agreed to pretend that the pandemic has ended. We've seen 7 straight months of declining year-on-year revenues for many industries in the USA, which feel anxious given the alarm bells ringing in the rest sections of the economy. We expect the economy to struggle under the weight of higher interest rates and to enter a short recession period at the end of the year, extending into the first quarter of 2023. Martin Beck, a chief economic advisor to the EY Item Club, says, "The retail sector is already effectively in recession, with the damage spreading as inflation combines with slumping household confidence to cause a marked slowdown in other consumer industries." It certainly may feel like it for Americans facing decades-high inflation, record gas prices, and ballooning grocery bills. Still, most economists say that the US economy is not currently in a recession. The government's hallmark measure of economic activity, gross domestic product, or GDP, made a contract in the first 3 months of this year, the first time it has done so since 2020. But the pullback primarily reflected a surge in imports rather than a sharp slowdown in consumer spending. Consumer spending rose at the fastest pace in nearly a year in the first quarter because GDP is meant to capture domestic production. Surging imports, a reflection of strong consumer demand, dragged down the headline figure. The US economy may technically shrink in the second quarter as well, this time likely a review of a slower accumulation of inventories. While consumer spending is expected to remain solid, that wouldn't mean the US is officially in recession, though some politicians and commentators would claim it. A recession is not a foregone conclusion. As President Joe Biden's administration has emphasized in recent weeks, Fed Chair Jerome Powell has held out hope for a so-called soft landing, a cooling in economic activity that doesn't lead to a recession, but acknowledged on June 22nd that achieving one will be very challenging. For the most part, economists generally describe the potential upcoming recession as mild and short. Estimates vary, but the unemployment rate is expected to rise from a near 5-decade low to around 4% to 6%. That's well below the 10% seen in the wake of the Great Recession and the nearly 15% seen at the start of the pandemic. Though it would still mean hundreds of thousands, if not millions, of Americans losing their jobs, it's worth noting that as hard as it is to forecast when a recession will occur, it's harder to still envision what one will look like. The world economy is facing a recession. The global economy is facing a similar picture of high inflation and increasingly aggressive steps by central banks to curb it. The world economy is again in danger. World Bank President David Malpass declared in a report released in early June. He noted that even if a global recession is averted, the combination of high inflation and slow growth could persist for several years. Economists at Citigroup Inc. pinned the probability of the world economy falling into recession at nearly 50%. In Europe, European Central Bank President Christine Lagarde has emphasized that a recession is not the central bank's baseline scenario for the Eurozone, but risks differ from country to country. In China, the world's second-largest economy, the outlook remains uncertain. The economy is showing mixed signs of recovery, strained by stringent COVID-19 measures and associated lockdowns, but the government is seeking ways to step in. Why selling your assets during a recession may be a mistake. Dimensional pointed out in the same study that if you invested $1,000 in the S&P 500 over 3 decades between 1990 and 2020 without interruption, your investment would be worth $20,451. But if you missed the single best day during that stretch, your investment would have dropped to $18,329. And if you missed the 5 best days in the market during that period, your investment would have shrunk to $12,917. This is still nearly 13 times your initial investment of $1. But Dimensional's analysis underlines the importance of how just 5 market days could reduce your portfolio gains by almost 37%. The duration of the recession not only varies depending on how serious the downturn is, but on what type of strategy the country's government and central bank, the Federal Reserve in the US, take to limit the damage. On average, recessions typically can last between 6 and 18 months. During a recession, businesses across a country lose money, which as a result can lead to a rise in unemployment. Hiring freezes, company liquidations, bankruptcy filing, and the closing of businesses. The rise in unemployment could also compel consumers to save their money instead of allowing it to circulate within the economy. A recession can bring serious losses. That's why it is essential to understand how much risk you can handle. Statistics show that staying the course during a downturn like a recession can pay off in long-term gains. Dimensional says that investors who sold investments after the S&P 500 entered a bear market missed out on average returns of more than 70% over 5 years. Thank you for taking the time to watch this video. Don't forget to smash the like button and subscribe for more crypto, Web3, NFT, and finance videos.